What's your current assessment of the global economy and financial markets?
A big question. I'll try and make it simple. I've never seen it with more bad signals, bigger concerns. And I guess I could go on with other negatives in it. However, it's never been a better time for investing.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Total U.S. federal debt now stands at $35.34 trillion, now exceeding U.S. annual GDP by $10 trillion. It's been growing at a faster rate than GDP for many decades now, and that dynamic shows no signs of reversing or even moderating. And on top of that federal debt lies the borrowing of households, businesses, financial institutions, and state and local governments. When you add all that up, the total U.S. debt exceeds $100 trillion. So, what does that mean for the future? Are we hurtling towards a sovereign debt crisis, as a number of analysts warn, or is there reason to hope the economy can handle that debt trajectory? For guidance, we're fortunate to welcome back to the program market analyst Gordon Long of MATASII, Macro Analytics and Technical Analysis Strategic Investment Insight. Gordon, thanks so much for joining us.
Well, thank you for having me again, Adam. Always enjoy talking with you. And I, by the way, I love the comments from your viewers. They're well thought out, and I get a lot out of them. Thank them.
All right. Well, look, they love you, Gordon. So I get asked the longer between your appearances here, the more and more people I say, when are you getting Gordon to come back on the program? So you're going to make them very happy today. And you've prepared a bunch of visuals for us, which is going to make them even happier. So I realize I'm standing between that right now. But real quick, before we get to it, just because it's been a little while since you've come back on, just to set the stage, let me start with the general kickoff question I always like to ask at the start here. What's your current assessment of the global economy and financial markets?
A big question. I'll try and make it simple. I've never seen it with more bad signals, bigger concerns. And I guess I could go on with other negatives in it. However, it's never been a better time for investing. That comes with risk. If you can manage the risk and you really do your homework, there are very few opportunities like this, specifically because in many ways the powers to be are trapped. And I'm talking about the Federal Reserve and the U.S. Treasury, and for that matter, other central banks and treasuries. And so their options going forward, as you talked about with the debt, are getting more and more limited going forward. And anytime that they get more limited, it increases your probability of being right in what you choose to do if you're doing your homework.
All right. Well, I think you just really piqued people's interest there. So let's get to that. So I guess maybe the best thing we can do is maybe start walking through these slides you created, and just to give folks a little bit of preparation. Many of them are sort of setting the stage for why the government is trapped. And then we'll get into how you think the government's likely going to respond. And that's how you as an investor, I presume, can kind of capitalize off of this.
Exactly. It's one thing to know what the trap that they're in. It's another to know what it is they're likely to do. One of the things that I have learned, Adam, over a few decades now is governments never really fix a problem. Oh, they try it. They'll throw money at it. They'll wait till there's a crisis, then react to it. But when I say they won't fix a problem, what they typically do is kick the can down the road. They buy more time. And so in doing that, what are their alternatives? Because the solutions they come up with are solutions that typically I've found, I don't know, 30 years, is increases fragility in the market, it increases risk in the market, it makes everything even more unsustainable, but they keep kicking it down. And the changes they make, and this is the key message I leave with the listeners, is I don't like to use the word they cheat. What they do is here's a better way. They change the rules.
Yep.
And by changing the rules, they don't tell you necessarily what rules they changed, and you'll eventually find out what they were after the fact. I'm not saying what they do is in any way nefarious, though it is hidden. They get better reaction, but you can count on them to not necessarily fix the problem, but do something that's hidden and behind the scenes. That's how we got out of 2008. We changed mark to market or to mark to magic for the entire derivative structure, never changed it back. And I can go through other kinds of examples. I expect that again, because these problems, the world is not coming to an end. We're going to always facing crises after, and we will react to them. It's knowing and anticipating that as best you can in advance.
All right, fantastic. Well, here, let me pull up your slides here so that folks can really start to get a visual of what exactly you're paying the most attention to. Here we have your table of contents here. Maybe I should just start with the first slide itself, but if folks are watching this on replay, you can get a sense for how Gordon's mind how he is thinking through this process by looking at this table of contents here.
Yeah, what I was hoping to do, Adam, is actually springboard from the last time I was here, because the last time I was here, I was laying out problems, but I didn't really have a chance to get to the solutions, or what I think if they're not solutions, what the fix will be when they happen and what they have to address, and that's really what I'm hoping to do here today, and because they've got two huge issues they've got to face. And one is this astronomical growth of debt, not just government debt, but corporate debt, home debt, and at the same time balancing continuous economic growth. And how do they do that? They have to do both in some fashion. And I'd like to explain what limits them, and what therefore will probably drive the solution that comes out of it. And as investors, our job one is to know what to expect from the powers to be. If you go to the next slide.
Yeah, I will in just a second. Right before you leave this slide, there's a term that you use here, creditism. Do you want to define that now or define that later for folks that aren't familiar with it?
I actually want to get into that too, and I got a couple slides on it. But we have changed. Capitalism has morphed into creditism, and by creditism I mean the ability to increase economic growth through increasing debt or credit, and that's what we're building on. That's how we're creating under the current definition of how we call GDP, which was based on a sound money system, not a fiat-based currency system. And so, because we now have a fiat-based currency system, the inclusion of debt treats the GDP formula differently. And that's why I think I explained last time the big differences we have between GDP and GDI, and why they don't work. So, but I'll show you a couple of slides in creditism and how it fits in with this massive change that's happening, not just in the United States, but more importantly, what is happening globally.
Okay, great. All right, well, look, here we go.
Yeah, this chart that I'm showing here was a chart that I ended last session with you on. And I thought it was a good place to start, where what I was showing was this great moderation that I believe has ended here in the middle in the colored section. And so where we should now expect to see on the right hand side is higher volatility, same as we had before. To a large degree similar. Higher volatility, higher inflation, higher interest rates, higher risk premium. And this is similar, as I said, to what we experienced prior to the 40-year period of the Great Moderation. And during this Great Moderation, that we've come to call it anyway, we saw, as everybody's well aware, falling interest rates, low volatility, low risk premiums, extremely low levels of inflation. And it was consistent for 40 years. But when I was last here, you'll note here on this chart, you see we have high core CPI on the right, but we also then a little lower, you see GDPI and yields rather lower. This is a relative scale. So there's nothing absolute, but you can see what we had then. And if you go to the next chart, I'll show you what I updated on Friday to really demonstrate what's going on here with the shift. And so you see here this is the same chart as it. You'll notice that we now have GDP relative to lower yields and lower core CPI. As we all know, CPI has come down, yields have been falling, and the GDP relative is actually flat going back from pre-COVID levels. But this change is important because because what happened here is the results of a massive increase, and I'm sure all your guests have talked about this, of fiscal deficits and a $7 trillion insertion into the GDP. It's going to deliver increased GDP. That's just a fact. Whether it's good GDP or not, it's GDP. But the question is, of course, that's what we're here to answer is it sustainable? Should it be sustainable? And what are the costs of it with the government with us going forward? And so what we now have relative to the great moderation at this point in time is higher levels of volatility, but they're not really high yet. We're on the road, we're in transition. We got higher inflation than we had during the Great Moderation, but it's sort of manageable down in the 3% range. We can call that manageable. Higher interest rates than we had then, and little change in the risk and little change in what I'll refer to as the risk premiums on both bonds and equities. So we're transitioning. We're really coming out of the COVID shock is what the bottom line is here. So we go to the next chart. You know, and you mentioned it, and I found it just stunning. We just broke through. Credit and debt has been growing geometrically since the early 60s, actually since we started going off the gold standard. I know that was in August of 72, but we were doing things before that, even from 68 on. But we went from 1 trillion in 64 to 100 trillion last quarter. So that is just dramatic. That's exponential. Exponential curves can't last, or can they, until they go vertical. But we're not there yet, by the way. This is very steep, but it isn't vertical. So it begs the question. But so big point here, it goes back to your thing on creditism, not there yet on creditism, but credit is, I consider, equal to debt. And it is. It's the opposite sides of the same coin. And there's a little bit of difference, but it zeroes out quite quickly over time. So that's total credit and total debt in the United States. But the next chart shows the global picture. Okay, because this is not the solutions we're going to have to come to are not just standalone in America. There's a global issue that will be resolved in a similar kind of fashion. And so if you look at global debt, it's now hit a record in the first quarter of 2000 of this year of increasing by 1.3 trillion in 3 months. In 3 months, it went up 1.3 to 315 trillion. And since the global pandemic, global debt has surged 21%. Adding 54 trillion to the global debt, and the total government debt, and this is where I really want to get to, because this is what they truly can control, has exploded by 20 trillion since COVID. So but what does 20 trillion mean? Okay, and not in terms of absolute value, but what's it mean to the economy? And so this next chart, I've tried to try and make sense out of that part of. We had 62 trillion in government debt on a global economy as measured by GDP in 2020, going into the COVID, of 84 trillion, 85 trillion dollars. Government debt in 2022 was 82 trillion on a GDP of 104 trillion. So it's the math. We got 20 trillion growth in government debt, but we got $20 trillion in GDP. They're almost exactly the same. Mm-hmm. So what's transitioning here is our GDP is measuring basically the growth in debt, growth in credit growth, or more specifically, the rate of credit growth. Everything you have to pay attention is the first derivative. It's the change. And so be careful on some of my slides. It's the rate of change that's really important here. So are we growing debt or are we growing GDP? And the answer is they're both. They're now inextricably tied. And so if you
Gordon, sorry, is it also fair to say too that the multiplier effect of debt, right? You would take out debt, but it would have a multiplying effect on the economy. It seems like we're now at the point of diminishing returns where $1 of debt just gets you $1 GDP, and there's no benefit to the debt anymore. And this would obviously be a precursor to the point where someday more debt equals less GDP. You know, $1 of debt doesn't give you even a full dollar of GDP.
I'm afraid to tell you we're already there.
Okay.
Globally right now, that's the case. It's a dollar for a dollar and getting worse. I'll show you what it is already in the United States and what it takes. But it takes increasing to get growth. It takes growth in the money supply. It takes growth, at least how we measure it now. And I won't get into the absolute flaws in the use of the GDP formula, which in my assessment should have been changed when we came out of Bretton Woods, or rather when we got off the gold standard. We should have modified it, but it was a convenient lapse to not change it as we go on and measure GDP. It's completely misrepresents global economy, global activity. However, it's still what we all use, and it's meaningful as a way of at least looking at the economy. If you really looked at GDP and you factored it out, I believe in the United States we're actually shrinking, but we'll leave that for another discussion.
Okay.
This chart here, the next one, I want to move through so we can get the solutions here, Adam, if we can. This chart, it really rings home. And well, so what is exactly the shift in our global economy to achieve global growth? The U.S. government debt since the advent of quantitative easing has actually grown faster than the economic growth as measured by GDP. I don't know how many times, I see this chart seldom. Matter of fact, I had to put it together. And this is, everybody should be looking at this chart and says, how can you go at this rate, grow economic or spending and through debt and credit faster than the GDP? Because there's profound implications of this that for some reason the media doesn't want it, or it's not being discussed. But that's what happened. QE came in 2008, just after 2008, really to stabilize the economy. And again, I'll show you that in a second of what it meant and how they did it. So back to the point you just mentioned a few minutes ago, Adam, this chart here I'm now showing is what it takes to grow the GDP in the United States. If you can just flip the chart, Adam, if you can. There, that one. And this is the point again that you made. It takes as much as $2.50 now, not a buck, $2.50 of new debt to actually produce $1 of growth in the United States.
Wow.
That's where we're at now. $2.50 of new debt to get $1 of growth. But in here is also now takes, and it correlates, $1.50 of deficit growth. The deficit that we have that we're growing, not the $34-35 trillion that we think is our national debt, which in fact is not the correct way of even looking at it, but let's assume it is. That is growing at 1.7, probably getting close to $2 trillion a year. So it's taking $1.50 worth of deficit growth in our current budget or tax revenues, these and our growth, to actually grow the economy. So obviously, an adjustment crisis can be counted on. It's coming, and they know it. So things have to be done in advance to at least minimize it, offset it, or kick it down the road, or minimize it in some fashion, because we're unable to sustain the productive economic growth, or it's just or maybe more important, we can't produce that amount of debt because there's not that amount of collateral that's out there. We can't even grow the credit right now. The banks in themselves are not growing it fast enough and lending it out to sustain the growth of the debt. So it's highly unlikely that even debt growth can actually be achieved that parabolic curve of trying to lift it. How are we going to lift it further? But the government, in actual fact, has to do that. Or we have to really reinvent the system. They've got to grow. And it's not the US just. The global economy has got to grow the credit and the debt system as it's currently defined, or something, it's going to come crashing down around our ears. And I don't see that happening in anywhere near the current future.
Sorry, and
So
when you say you don't see it happening, meaning you don't see the exponential curve being able to continue to be continued, not that you don't see a crash happening.
I don't, the curve shouldn't increase, but it will. They will continue to do things to increase it. All it does is pushes out the inevitable that it can't go vertical, as you just said. It just can't. It will come down. But before we get to that, they will make change. They will do changes in the short term, and in the longer term, depending on how that crisis unfolds, there'll be another Bretton Woods a global meeting. By the way, over the dead bodies of of a lot of various countries who don't want any participants, we'll be forced into something like that. And reinventing. It's much too soon to know exactly what form or shape that's going to happen. It is going to happen. It's inevitable. Probably sometime before the end of this decade. Could be into the beginning of next decade. We don't know. There's too many variables in here. But I do believe that we're going to push that debt pyramid even higher.
Okay, and sorry just to stick on this, but just to summarize this so that folks are following. You think there's going to be some big reckoning at some point, some crisis that's going to force us to basically have to adopt a brand new regime at some point. But between now and then, you think there's enough rabbits left in their hat of tricks that they're gonna be able to keep this game going for a bit while longer. This is sort of what you were saying at the beginning, right? Where they're getting trapped, so we kind of have greater confidence in what they're going to do next.
Exactly.
Okay, great.
Yeah, but the crisis is inevitable, and there's nobody that's naive to it. They know it, and they're trying to buy time because they're also hoping to come up with a real solution, and that is a meeting of the minds and countries coming to some level of agreement. But right now we have such serious global conflict issues and regimes as we shift from a unipolar world to a multipolar world. The United States is no longer the cop on the beat. The rest of the world, we're not the leader that we were. So, and that's not down on America. It just says that there's a sharing of power now that's trying to come into existence with completely different views on how economy should be structured, whether it's complete socialism and degrees of it, what degree of capitalism, how you control it, how you control the narrative and the censorship. There's so many unanswered questions that they can't resolve yet. They can't get people to the table even if they are trying to do it. But this chart, the next chart here, Adam, is I don't think the right now that the inflation rate we're actually at a very close point in this the crisis itself pushing an event, and we've now reached the point where GDP growth will require debt growth at sufficient level that even maintaining an inflation level below 3%, that's what I'm trying to show here in this chart, will be nearly impossible based on the path we're currently on. To produce more money, 3% inflation is not going to stay there. It's going up. It's going to push itself up, not come down. Some elements will come down. There's no question, but there's a lot of inflationary pressures out there. Something must change, and it will. The world's not coming to an end. It's my experience. As I said, they'll change the rules. But right now, even 3% inflation, it's ridiculous. Not at the rate of increasing the debt, unless they stop producing it, change the path. Can't happen without serious. It'll make the Great Depression look like a minor adjustment, and it can always happen. But next slide. Adam here. This is a chart I said, wait, and we talk about creditism here, because we need to fully understand the importance of credit creation in today's global economy. And the chart captures here the migration since 1968, when the U.S. first initiated the shift from selling its debt in gold to credit IOUs. And so the blue is really the capitalist system. The black bars is increasing use of credit. Okay, and the today credit creation now accounts for 60 on the right side, 61% of the funding of the U.S. government debt that's owed. 61% now is credit that's having to be generated just to keep this system going. And as a consequence, the world has shifted from capitalism. And this is important for those who really don't appreciate capitalism's about savings that's redeployed as investment into productive assets. So it's having savings, it's applying it into investments that are the productive investments. That is, they create revenues themselves or profits. And when you get that, you get an increase in the standards of living. What creditism does is it's not savings, it's credit. We create credit. And so when we create it's being redeployed, not necessarily into productive assets. It's actually being primarily used in consumption. And once it's used, it's gone. And so the black bars have been more or less flat, if you really study this, since the 1990s, the dot-com bubble. And the savings has continued to fall, has been made up here. If you see it down the bottom, savings have been falling, has been made up of financing from the rest of the world, in red ROW, and the Federal Reserve, which up until recently has been increasing its balance sheet and its bank reserves. We took it up, it was getting close to $10 trillion, but certainly 9.2 trillion. And now we've been taking it down to close to $7 trillion. And don't for a moment think that what is going on behind the scenes is the Federal Reserve and others buying time to get that balance sheet down to a level, because in my opinion, that balance sheet will be 12 to 14 trillion dollars within 3 to 5 years. Oof. And with that kind of explosion, remembering we were almost 10 a while ago, if they did that, it would destroy the dollar, absolutely destroy that. But with right now, it'll somewhat protect the dollar. And it's not a dollar issue too. It's because we're all fiat and they all are tied together. As Bernanke's in Enrich Thy Neighbor, where they move around it in debasing so you don't see it because it's all relative to the other trading partners. Where you see it is in purchasing price. Inflation is a loss in purchasing price. It's not a change in the currency. So they're trying to protect the currency right now. Any questions on that? Adam, I went a little quickly on the credit. Does it answer that question you raised earlier?
I think you've sufficiently answered it. I think we could have an entire discussion, hour-long discussion just on creditism. So I'm avoiding asking the many questions I have around it, but I think for the purposes of walking through your logic here, I think we got it.
Okay, good. But so next chart, I'm showing from the Great Moderation, we were really fortunate in that 40 years, because we had structural deflationary forces working to assist us. Because we had inflation, we played games with hedonic substitution, imputation, all these statistical games, and the shadow stance. John Williams will show you it's north of 13 to 16, 17% if you measured it back in the 1980s, 1990s kinds of levels. So we've been playing games and kind of hiding it in many ways, but we've been assisted because of these structural issues, are not issues, things that were going on. And the biggest one, and they've all changed. That's the point I'm trying to get to here, because the chart on the right at the top shows you that China itself saved us 4 times since 2008 with this credit. It shows the Chinese credit impulse, where they're spending as the engine of this world right now, the economic driving force that it's been, has saved and created a level of stability over the last 10 to 12 years that without it, we would have had a problem. But it not taking away from their credit spending, which have now really aren't addressing it anywhere near what they did before. The Chinese were exporting deflation by labor arbitrage and also offshoring all of the jobs to it because of their labor pool. They exported deflation to us, which helps our deflation. That helped to fight our inflation that was hidden from us. But that's changing. they've got really problems. And also it's not as impactful today. So it's changing. We're seeing a reversing of globalization, financialization, and mercantilism. And those aren't just big fancy words. Globalization delivered cheaper goods, financialization delivered cheaper rates, and mercantilism delivered cheaper currencies or higher level value of currencies that bought you the cheaper goods. So it's allowed us to maintain our standard of living, even though we're consuming in the United States vastly more than we produce. I mean, that's the fact, and that's why our balance of trades are chronically getting worse, and why we keep doing this without a collapsing standard of living. Though I would argue we're now seeing it right and visibly in front of us this year. As people are squeezing at the stores, you're seeing Dollar General, and I won't get into this whole discussion, this low entries they can't even make it go on their margins because their core users are getting squeezed so badly. That is, purchasing power has fallen to such a level that the standards of living are now falling. So you got also, we had this debt was manageable before, the third point here. And now sovereign debts around the world are as serious as the United States, where interest rates themselves are a bigger percentage than they used to be. We have slowing demographics right now. We've had years where there was more people coming into the workforce. In the 90s, it was the female population was now really entering the workforce. Now it's broken the glass ceiling, and it's every family, most people work. But we've had a change in the slowing demographic even in China. There's fewer and fewer workers as we have fewer and fewer children. In the United States, it's 1.1, and that's why they're pushing this immigration. I'll say it totally wrongly and ineffectively, but they're pushing it. It's just not the United States, it's Germany, it's every developed nation is doing it because they know that the only way to get their economies going is they need more consumption, which is more workers, which drives up the GDP, more taxes, etc. And it's because these new workers buy goods and services and create, if there's jobs, and create work. And then we have a slowing productivity also associated with the tech disruption. And the tech obviously improves productivity, but it's, again, as I said earlier, it's this rate of change that it's not as impactful as it was because it was so dramatic before. And you can see it with the adoption of AI. Corporations are desperate to figure out how to increase productivity as their top line is being squeezed right now. None of this is, and I apologize, none of this is probably new to a lot of your listeners, but it needs to be reinforced that they've went away. They're not helping us fight inflation. These were key structural deflationary hidden behind the scenes that were helping us. And all of a sudden, when the great moderation is shifting, and that's why it's changing. It's changing because these elements are changing.
Yeah, no, this is super helpful for that. And yeah, I mean, we get accustomed to the way things are, and we've been in this great moderation period for so long that I think everybody thinks that that's just the way the world is. And you're doing a good job of explaining why the playbook, ready or not, the playbook is changing because these key forces are reversing or going away. A couple of just super quick questions before we get to the next slide. So one is, as you said, China sort of rescued the global economy several times in recent memory. And you're basically saying they're not coming to the rescue this time, right? I mean, looking at your chart here, you expect this impulse not to bounce off the zero or whatever mark it was. This thing's going to, you think, keep going south this time, correct?
I think that they will have a surge sometime in the next 12 months. Though it'll be over Xi Jinping's dead body right now. They're going to be forced, but it won't be enough to really solve the global problem.
Yeah.
Because he's really
like at the start of this year, everybody was expecting that China was actually going to become a net tailwind to the global economy, and that just never showed up because they have some very big structural problems. Yeah,
and it's getting worse by the day. There's structural problems. China will begin to solve them, but it kind of reminds me in many ways. It's not the Japan scenario I want to use, but it's similar. It's ours, and the roaring 20s that we went through. We were just exploding manufacturing facilities in every way. companies were growing. I know we ended up with a stock market crash, but it's more a reflection of just this massive growth we had in America. And look what the 30s it took us to sort out this problem. Now a lot of it was bad finances and then the Second World War, but it was a big hole that really, frankly, took us the New Deal and a change in how the financing of our government through Roosevelt's New Deal and the Second World War to get ourselves out of it. China's facing that similar sort of thing. And you see it with their youth unemployment at 22, 25%. Their job in China is to deliver jobs. That's the first and foremost the responsibility of the CCP. And if they don't do it, the people are up in arms. And also, the only way they can save is in real estate, and it's going south.
Right.
And they're not stopping it. So they have really serious social issues. He can drive up the credit and put it out, but he'll get inflation, and he doesn't want to lose control. He knows he has to improve consumption, but he doesn't want to do it too fast.
Right.
Because that comes with debt. It comes with other kinds of issues. He's just kind of stuck on that. But we'll see what he's forced to do. Right now, he's frankly spending his money on building out military equipment, and I'll call it Fortress China. I'm not saying he's preparing for something, but he's quite clear what his priorities are, and he calls it Fortress China.
I just literally came in this interview from another interview where the guests speculated on why they are doing that military buildup. So folks, if you're curious, go watch the video that was released right before this one with Jam Carson. Well, look,
I'm trying to play it down a little bit, but
I know
they are incredibly aggressive. Look what they're doing with their shipbuilding. They got more ships than ourselves. Their entire military structure, but I don't think that they're actually looking for a kinetic war. We're getting a little off track. They have a whole different approach to warfare, asymmetric warfare, which they believe is, elite capture, trying to change policy internally and changing narrative and controlling it. There's been books written by two Chinese generals outlining 15 years ago exactly what the strategy should be. They're not looking for kinetic war, but they're ready for it if they have to be. That's their priority right now.
I don't want to take us too far afield, and we didn't even get into the demographic challenges that China faces. That it is very fast aging population, even older than the U.S. and a lot of Western nations, and aging more quickly, and a demographic imbalance because of the one-child policy and all that stuff. But basically, just the punchline I just want to make sure was super clear is that China is very unlikely to ride to the world's rescue this time round. The other thing too, and this is another thing we could talk about, probably for a whole interview. I just want to get a quick answer from you on, because it's something I scratch my head on a lot. I've had some demographers on this channel, Gordon, and talked about how the challenges that the U.S., the West, but U.S. Itself is facing. If you want to run our current economic model, if you want it to continue running, you need to have an ever-growing population segment of working age employees. And we are already seeing that key demographic of 25 to 54-year-olds decrease in this country, along with our slowing birth rates and everything going on. And so immigration, if you want that playbook to continue, immigration is going to have to be a big part of it. Right now we have what I would consider to be a very hard for most people to understand immigration policy, largely referring to the border and the huge surge that we've had in illegal immigration. And I just wonder why the government isn't being more direct. If that is the policy of these Western nations, which I would totally get, if they just said, hey, look, guys, we need more people coming in here because we're not growing our populations fast enough. Why don't we just put them on the table and make that the discussion? It's not being explained to us as a populace for why we currently have this very hard to understand border non-policy at this moment. Do you have any thoughts on that?
Yeah, it's classic government. They get the direction right, but they get the implementation totally wrong. And then the implementation here is a disaster in almost every country, because I'm an immigrant. I'm a supporter of the immigrants. I think it's just what we have to do. And I believe the American people would fully support it if it was done in a planned, managed, structured, methodical way, and we were informed. And we didn't. We were told this time last year, we were told the border was secure, there was no immigration. Then in Massachusetts, we were told on Labor Day last year, because suddenly the kids had to go into school, that we had a mass, we were calling in the National Guard to help because we had a crisis on our hand. And now a year later, we're told it's going to be $1 billion on budget problems going forward. There was no above board. They did it. Now they should be doing it, but not in this fashion. And part of this, the mistakes is this is the first immigration where we're bringing in different cultures. We're bringing in different religions with different beliefs. Shira law, they have a they don't integrate the same way. They can be integrated. It requires education and processing and also sorting out how people should be brought into the country. But it's a real problem. You just have to look up look in Germany and Japan, or Canada rather, and Germany, to see the issues that are falling out. We're going to have a huge problem over the next year to 18 months. It's going to impact our economy, whereas it should have been something that is a major contributor to our economy. We got kind of off track here, but immigration is central to all of the G7 countries building are sustaining itself, because without it, the demographics say we're walking into an insurmountable problem. And I think anybody who studied this knows it.
Okay.
And we don't talk about it. And I like the point you made, Adam. Tell everybody, explain it, lay it out, like we did with the Marshall Plan in the Second World War, why we were going into Germany with all the goods. This is the right way to do it. We didn't do it.
Yeah, absolutely, exactly correct. And I'm right there with you, where I think if we had a policy that was thought through and well communicated, I think the country would get right up behind it. Absolutely.
Exactly.
Yeah, let's just come up with a strategy. Let's figure what's a good annual number. What are the type of skills that we want? What do we want to have left over as an amnesty percentage? And yeah, let's all get on behind it. So anyways, to your point, I think you answered my question right away, which is
they're using it as they're afraid of being caught on the wrong side of the political argument, because whatever they do, the other side will argue against it, and they've taken the easy way out. It takes real leadership to lead the American people in the right direction. We are not seeing, and I'm not being political, either party are not bringing the type of unifying leadership that this country needs. That's our missing ingredient. I'm not saying we don't have good politicians, but we do not have unifying leadership right now. Anyway, you were going to say something.
You'll get no argument from me, but again, you made my points, which is it is a key issue. It is, for those that want the current economic model to continue, it is an essential input. But right now, government is botching it with its implementation. Okay, sorry, I know you got a few more slides to go, so let's keep on going here.
Yeah, the next slide is something that, because everybody wants to say, well, let's get what's it mean to the market. And today a vast amount of our wealth is paper wealth. It's highly dependent on the vagrancies, and this is what these charts are trying to show here, of a highly leveraged quadrillion-dollar derivatives market, and their claims, which can suddenly be worth nothing. And then we have endless examples of this. An example: today's markets are operating and trading on creative vehicles such as, and I'll ask people, have you heard of these? Collateral swaps, collateral transformation, liability derivatives. I can go on. This reminds me of 2008 and 2000, where we suddenly learned of a whole raft of derivatives different than the time before that brought down the system. And the latter part, those liability derivatives, as recently as last spring, brought down the British Prime Minister. The gilt almost crashed, or did crash, and it sent the UK pension industry in total collapse. So without anybody being aware of what is going on in the derivatives market, and these things of collateral transformations and collateral swaps are showing you the problem I mentioned earlier. You can't have debt and credit without collateral, and it's these whole concepts of rehypothecation and novation. If you don't know what they are as an investor, get out. You should not be in this market. If you do not understand these things, you do not know what you're doing. And the stock market is nothing more the Potemkin village of what's really going on today, and that's the trading in the in derivatives. And this next chart proves that point, Adam. That if you look at the bottom, this is volume. This is a stock market. We've all seen this going exponentially, very similar, mirror image of debt and credit. But you notice that the volumes of stocks are absolutely dropping. And there's a number of reasons that is. Well, one, we have some buybacks, or the stock pools are getting smaller and smaller, and we're getting fewer and fewer stocks as they're taken over. And the floats are getting smaller. So, whoa, that stock should be going through the roof if there's fewer of them. Well, just a minute, what we're trading is derivatives. And we're trading derivatives not just on stocks, not bonds, not currencies. We're trading derivatives on economic indicators like inflation rates, the real rates. And you go almost any economic indicator. You could see it on Friday with on the labor numbers. There are derivatives that are trading behind the scenes. So the market that you see is just kind of a paper representation of what's behind it, and what's behind it are IOUs. Because, even ETFs, you don't own the stock, you own a derivative that has claims to those stocks, and they all work until something breaks. That's where you're getting this more risk. I didn't say it's going to collapse. I'm just trying to say we're building more and more risk into it. And last time I tried to explain the risk we're seeing with that could come out of a sudden buying panic. But the problem I want to get to in this chart is it's about collateral. We just do not have it because it's real wealth. Collateral is not an IOU, it's real wealth. And you only get real wealth if you grow it, you mine it, you produce it, or you build it. You can't print it. Paper IOUs like a dollar bill and stock certificates are only claims on real wealth. And they themselves, as I said, are not wealth. So honoring those claims in tumultuous times, and this is really important as you get into difficult times and countries disagreeing, and when we start to do things like we did with the Russian debt, where we just confiscate or our Russian assets, we just confiscated it to pay for the Ukraine war. It shakes financial markets because it depends on the solvency and the continuing operations of intermediaries, third parties, and banks who are dependent on the rules, the rules of law. And today, a vast amount of paper wealth is highly dependent on the vagrancies of this quadrillion-dollar derivatives markets that, as I said, they can suddenly disappear in a heartbeat. But it's ultimately the loss of collateral.
So, Gordon, can I just say one quick thing here? So,
Please do.
You talk about the importance of collateral as real things, real wealth, right? Physical things. And then you talk about claims on wealth, right? So the real things are finite, right? In amount. Claims can be infinite in amount, right? And so I think at the end of the day, what you're really talking about here is counterparty risk, where in turbulent time, when everybody trusts everybody and everything's going fine, yeah, these claims can continue to grow and they can get massively huge. So you've used a term a couple of times. I'm not sure everybody understands. You said quadrillion. For folks that don't know what a quadrillion is, that's the order of magnitude that comes next after trillion, right? So it is a magnificently massive number, right? And the danger is that in the turbulent times, all of those bets that are made through derivatives, all those claims, all of a sudden everybody wants to cash in their claim, and there may turns out to be multiple claims on the same collateral, right? And that's where this whole pyramid can come tumbling down, where at the end of the day, there's only that one piece of collateral, and there might be multiple claims, and only one person's going to get it, or everybody's going to get a fraction of their claim, right? So all of a sudden, many people might find out that what they thought they owned, they don't own as much of, or maybe don't own any of.
That's what's been consistent since 2000 and 2008. The crisis happens when people suddenly realize what they thought they had, they don't. Doesn't exist. Somebody else has also got a claim. It's like a car. You own the car, but you really don't, because it's held as collateral against you making your payments. But that collateral is sold with something called rehypothecation any numbers of times, and there's actually nobody that really knows. And at the end of the day, maybe it's not the car, it's some structure that car is built into. It's all over the place. So if suddenly you default on the car payments, who gets the car? you're using something everybody may be able to understand, but
Right.
when you're talking about major financial instruments, which are corporations, which are countries' dam systems, countries' utility systems, that are held with foreign aid. Now, it's huge, and it can happen very, very quickly. Again,
Okay.
I'm not trying to paint a negative story. It's just the more things we keep changing, we keep increasing the risk with the fragility of the system. And that's the point that we're now at if we want to increase more debt. And we somehow figure out how to get more collateral. Where are we going to get this collateral? Because we're out of it right now. We're not mining enough. We're not producing enough at a fast enough rate. This is where I want to get into some good news. And because there is some good news. And what you need to appreciate is that the period of the Great Modern, this chart here kind of look, these are nice, orderly lines. They're incredible. And I don't think people, well, you need to understand this. And then what we need to read is that the Great Moderation has been very disciplined. And on the left, I'm showing the growth of M2, and then beside it, the growth of nominal GDP. And they're perfectly coordinated. I mean, these lines are incredible. And M2 has grown at a pretty consistent rate of 6% annually since the dot-com bubble bust. 6% consistently. You'll see a little bump in 2008, and you see a little, and in the COVID money where we really pumped it out, you can see a little bubble there, and it shows up over in the GDP. Down the first little bump is the 2008, but it comes right back on. It's like a boundary condition. And these are tied into the global balancing that goes on between countries. If any one country gets too far out of some of these boundaries, because they have different rates, mind you, it causes huge issues. That's why they so closely tie this together. So, and similarly, you see that the nominal GDP has been at approximately 4% annually. And where I'm going on this is what we started with. Well, how are they going to grow debt, and how are they going to grow GDP? What do they do? Because all of a sudden, how do they get the 6% M2 growth or more, and not inflation? Because they're trying to tighten it up. And how do we get 4% GDP, as we showed in the previous chart, of how much debt growth it takes to get that GDP? They're kind of caught in here. So you'll notice that in the falling bond yields follow similar to the charts that I'm showing here. I didn't put a chart in, but bond yields are also within a boundary condition that during the whole Great Moderation is steadily going down within 1.5 standard deviations on any crisis. This is not a coincidence. That's the point. This is they're attempting to manage it. So how would they manage it? If we go to the next chart, and I don't want to get technical. I just want to try and make it as simple as possible. On the left side, I'm showing where the M2 going on 3 different outcomes. And then on the right side, I'm showing how it relates to economic theory of the quantity of theory of money and the GDP formula. But on the left, there's our M2 growing at 6%. And on the very top, what we've had is in this era, that GDP, that's what these 3 bars on the left side are showing, is the GDP has been made up of 4% growth, but it's been 2% real growth and 2% inflation. 2% plus 2% gives you 4, and that's the GDP. Or in other words, the nominal subtract the real gives you or subtract inflation gives you the real rate. That's just basic the law of economics and how the bond market works. That's what we're running at. And so all of a sudden, part of the control too is managing that 2% and 2%. That's why we're so hard at getting down to the 2% inflation. The middle chart says, well, what we're seeing is real difficulties. They've been sustaining it, but the reason we were sustained it between 2008 and 2020 was quantitative easing and all the various versions that we did to pull demand forward to keep this thing balanced. The problem we now have is really shown at the bottom is, well, how do we get the growth up to 5% or 4%, even maintain it? But we need to get the growth up to get the GDP up, which means we need to push up the debt. And if we do that, we suddenly would have 3% inflation or 4% inflation. So that is being pushed up. So they've got to fix that. That's what I'm trying to get to. And that's what these little arrows through the parts of it. If you go to the right, and again, I apologize being too detailed for some of you.
That's right. You're explaining it well.
Okay, then thanks. The GDP over here, if we want it to go up, the theory of money, and it works, it's a fact, is the money MV is equal to the my eyes here are not quite as good as it is, but it's the price times the volume. So the price goes up, the volume goes up, or there's a balance between the two of them, and that must equal MV. And MV, and what that is the money supply that you're increasing and the velocity of how you turn the money over. So if we increase money supply and volume stays the same, we've got this increase on price and the price and the trade and the total amount of goods. So what we really do now need to do is we actually don't want the prices to go up. We have to get the goods to go up. And this is, frankly, what Ronald Reagan tried to describe, maybe not as effective, is what he called supply economics. We've somehow got to take that money that we're pushing out, and we're going to push out more money to get the GDP, but the money has got to go into supply side. Another way versus going into inflation, because it's not. Remember, I said it's all going into consumption right now.
Mm-hmm. It's got to go into production, is what you're saying.
It's got to go back into asset producing debt. That's what's got to be, productive assets. So easy to say, that's no problems in that. How do you do it? It's not going there. Companies make the decisions. Why aren't they doing it? They can't see the top line growth. That's why they're buying back their shares. They don't, if they had a way to spend their money, they wouldn't buy back the shares. They do maybe some of it, but not right now. We have the world's greatest debt for equity swap we've ever seen. It tells you growth is a real problem. So we've got to increase that debt. Or rather the real growth is that we're after. And I could go on a little bit more on that, because they also tie into the GDP right below it, where it's C is for consumption, G is for government, I is for investment, and then of course X is for the net of exports and imports. That's the X is negative for the United States. We borrow money, so the I straight through the roof. The government's borrowing it, so G's up, because it's the investment that came up. The money's then sent out as transfer payments for entitlements and other things, and programs such as the Green Deal, climate change, all of the programs that we've been implementing here for three years, which is consumption. So the GDP is really, that's why we said right at the beginning, it's nothing more than debt driving all three of these. It's not just triple counting, it's how we're doing it. And so we need debt to grow the GDP. That's what we're in. And that's the problem that we now face. And so the question is, how do they do that? How do they get out of it? If you go to the next chart, we knew this was coming, because this shows this on the right, the dark chart on the right shows bond yields, risk premiums, that is term premiums. The longer, right now we're talking about the uninversion of our yield curve here last Friday, but the long-term yields need to be higher than the short-term, but they're going to go up. They should be rising relative to the short-term, even when we start to reduce the rates. So the risk premiums that I said right at the beginning haven't been changing. They're going to hold in there or higher on the longer term, which will force yield curve control. It'll force another version of quantitative easing, but it won't work. It's not enough. It doesn't do the job. They'll do it, but as the curves on the right are showing, the market doesn't believe it. They don't believe it's going to get down below 3.5 on the long-term bond. Not going to happen. Maybe partial. it's going to trade up, and the neutral rate says, and volatility says, no way. And this is serious money. It's not going to happen. You guys aren't you doing the arithmetic? So I don't care what the narrative is for the public. It's not going to happen. So it's already been baked in. So when the rates go down, and then we'll take them down, and we will do yield curve control. But we're going to get higher risk premiums on the bond term premiums on the bonds, and we're going to higher risk ratios, risk premiums on the stock market, which is not good for either one, by the way, not good at all. So that's what they're grappling with. And we get back to this next chart is inflation. And we're tracking right through what I call inflation hasn't been beat. We're totally naive. We have not. What we did is we've got over the COVID shock, and it's almost ran its course. And even then, we've only got back to 3%, and service is an issue in how we count it. But we're kind of back. We're kind of over it. It's at the bottom. But we're now beginning to look at the issues associated with wave 2 and wave 3. And the next chart really, I think I might have presented this one other time on your show or with your audience, but wave 2 is still, as I said, it's still ahead, and it's going to be about services. And that is the skilled wage pressure spiral that we have, and it's underway, and it's going to get worse because of a shortages of skilled labor, a shortage of skilled labor. Mm-hmm. It's really going to show in these productive assets and any kind of reshoring that we have to do. And it's going to force prices. There's going to be pressures there. Both parties are talking about tariffs, and we've already started that. Tariffs are incredibly inflationary. We're going to have smaller disposable income with higher prices. Energy, we're writing into law regulatories that are crippling our utility infrastructure in most of the G7 countries. We're going to have to pay a price, and it's coming. And food shortages, of the issues we're doing to the farmers and agricultural land, fertilizer restrictions, there's so many different laws that the farmers themselves are having trouble surviving. These are all negative. Yes, I understand. But what they're saying is inflation is still in front of us. There's more to come in the second wave. I'm still of the school. I think there's a third wave, as there was in the 70s. We went through the same 3-wave structure then, and there was another example even before that. It may not be as dramatic. It may be different. It may be stretched out. Who knows? But wave 3 to me is going to be about shelter, storage, or shortages of shelter. We talked about the immigration. We have a real serious shortage. They stopped immigration in Canada, or slowed it dramatically, because they don't have the housing. Mm-hmm. And it's a common problem where they can live. They can't get them out of the temporary shelters that they have. So the prices are going up. The taxes are going up to pay for it, and property taxes are going up. So everybody's saying, oh, their house is now worth dramatically higher, if you're lucky enough to own a house, dramatically higher. But are you selling and moving? You're still paying more. What the issue is, your property taxes are going to go through the roof. So suddenly you're on a fixed or a certain income, your taxes are. I know people that are having to sell their house because they can't afford the taxes and move. That their Social Security doesn't pay the taxes, and that's going to get worse because the towns can't. And at least up here in New England, was what we're seeing. It's coming, and then you're going to finally get currency debasement. That is, they just print the money, and that I said earlier, where the balance sheet is up to 12-14 trillion from the 7 trillion now. That's when we're just flat out printing it to keep the thing going, and that's still well in the future. Make sense there, Adam?
Makes sense in a depressing way. Yes.
Yeah, I know, but hold on. That's and what it forces here is they're going to do two things. They're going to the way we got out of the Second World War was financial repression, and we kept the real rates below zero for a sustained period of time. We also did it this decade to try and make the debt that we have, even though it's growing, being paid off in less dollars. We didn't pay off the First World War till I think it was maybe in the last 10 years. But we paid it off in rounding numbers because that dollar's then what it's worth today. It didn't even make the press. So what we have now, it's not going to be about lower real rates. It's going to be about sustaining higher inflation. So 3% and higher, and I think it will be higher than 3 and 4%. It helps the government grow the debt because they're going to pay it back with less dollars, less valued dollars, and they're still, your taxes are still going up to pay in the current dollars. So it's that element where they can use the inflation to their advantage, and they have no choice because
Okay.
they've got to pump out that debt. So they know they've got to absorb, they take the inflation. The other side of it, I'm sure I bored some earlier, it says, okay, but just a minute, how are they going to get things into the productive assets? And it's my studied opinion here, is that we're going to move to off balance if we're not already doing it. I'm not sure we're not already doing it, and that is move to off balance sheet. Let me repeat that: off balance sheet, what they call contingent liability guarantees. And what we've been doing this for years. When we, for example, we give out student foreign aid to countries, we actually don't write them a check. What we do is we guarantee the loan with terms and conditions that they give us, that they're going to use that money for certain things or pay it back, but or use it for certain things. If they don't do it, and then the money is actually lent to them by the banks. So the banks charge them premium rates, make a lot of money, but they don't care because they know that we guaranteed it if the country doesn't do what it said it would do or defaults on its loans.
Mm-hmm.
So we've got $220 trillion. Let me repeat that number: $220 trillion of contingent liabilities that are not on our books, but on our responsibility for that, and Social Security that's unfunded, disabilities that are unfunded, et cetera, if you went through it. So these contingent liabilities are a way what the government does is, and this will come out of the Treasury, where they target areas and guarantee the lending of the money. So you're seeing it right, I believe, right now in onshoring. Countries that are companies that want to come back, that's a huge investment. I can see the government, I'm speculating here, giving them loan guarantees with whatever stipulation, so that they would, or maybe full, just give them the money, but still treat it as a contingent liability on the books to bring them back on shore. They could be doing it with the new Green Deal. They could be doing it with climate change, or people with new technologies, whether it's solar panels, et cetera. The gamut is incredible. And the reason I suspect it might even be going on is because of the stealth lending that's created so much liquidity here in the last year and a half. I mean, it's just been phenomenal liquidity that's been flooding out of the Treasury.
You know what? I think that is a great potential explanation for this massive amount of liquidity that, yeah, it's been somewhat challenging to figure out where it's all coming from. We know some of the inputs, but I don't think we know all of them. I just want to note too that Michael Every from Rabobank, who I've had on this program a lot, he's been predicting this exactly as well, you know, sort of more both protectionist but command and control of the economy, where the government's increasingly getting intervening, but it's doing so at select points in the economy. It's not like a QE that just sort of all the you know, the stimulus is going everywhere. It's going into things that the government thinks are critical to either national security or goosing the economy in ways it wants it. So it's going to be sort of, some parts are going to get fed, some parts are not going to get fed.
That's exactly right. He's right. He's right smack on. It's targeted, and it goes around the banks who have to take the risk. The banks will lend it, but now they got rid of the risk.
Right.
So you're effectively targeting it, and it's direct. It's a quick. It's in many ways it's like modern monetary
Theory, MMT, yeah.
theory, that it's a slight derivative of it. But we're moving to a command and control economy. All the G7s are. I wrote my thesis paper this year was on the regulatory state, and that we have moved to increasingly a regulatory state to manage the economy. And when we get into things about hate speech and censorship and all that, they may be required, but it's more and more central control, central management. It's getting towards the Russian model of communism. I'm not saying that's where we're at, and there may be a blend that's in here, but we are definitely moving to closer to something that could be uglily called totalitarian. I'm hoping that America does not go down that road, but we're clearly moving towards it because they can't get through. Our Congress and our democratic system is jammed. It can't get anything through the elected officials. That's why everything's being done by executive order, or it's being done through regulatories without even congressional approval.
Yeah.
And that's why we just had the Chevron doctrine, which is the Chevron deference, was overturned in the Supreme Court. They're saying this is unconstitutional. You could do it, but it needs to be approved by Congress. But they can't get anything through Congress. And we talked about immigration. That's an example. We can't get agreement on what the immigration should be, and that's not unique to the United States. The democratic system is getting so factionalized and polarized that it's stopping its ability to do anything that's major and creative unless there's a massive crisis. That's coming with the maturity of democracy, something we've never experienced before. It's going to force a change in our democratic process sometime in the next decade. And Xi Jinping has very strong views of what it's going to be and that we're wrong. But the current democratic system is doomed. He's very clear.
Yeah. Okay, so we have these
right, but anyway,
we have all of these pressures building. Looking through your lens, that's going to manifest in higher inflation. Perhaps two more big waves coming ahead of us. Much more command and control from the government. But really, I think the punchline, if I took the right one from all this, is that the casualty to all this, maybe the casualty we can have the greatest confidence predicting is going to be the purchasing power of the currency, right? So for folks that have been taking good notes and are at this point in the presentation, what can they do? And you mentioned at the very beginning, as scary as a lot of these issues we're talking about, we've never seen more bad signals in the market, or the concern set hasn't been larger, but this also yields some amazing opportunities for investors. So what's your counsel to people here who are looking to say, okay, Gordon, I get all this, how should I play it?
Carefully.
Okay.
But I also said this is the best time ever to be an investor. Because if we start printing more money, stocks are going up. Okay, now in real value, that's a different story, but they're still going up. And there's going to be also money in the bond market if you capture it right, where you're going to get higher yields. And if you leverage it properly, you're going to do fairly well without looking for capital gains on falling yields. So these are investment opportunities, but they come with risks that we've never seen before. Better returns, but they come with more risk because something can break at any given time.
Mm-hmm.
And how effective will our governments be in their reaction? And their track record is dismal, though they do eventually sort of figure out a way of kicking the can down the road and moving on to it. So, but during that period of time, we've had some pretty serious, 2008.com, we've had some pretty serious corrections. So the good news in this is they know this is coming. They're ready for it. They've been preparing in other ways. As you said, the first casualty is typically the currency. Right now, they're trying to protect the currency as long as they have, but it's showing up in lost purchasing power because they're hiding the real value of the currency collapse amongst the fiat currencies with the $650 trillion currency and interest swaps in Basel at the Bank of International Settlement. So they're being able to take currencies per se off the table. And the other issue is the United States, and this may shock a lot of people, I believe the US dollar will be the last to crash or the last to really fall. But it's, I believe, the worst currency. It's the most overvalued right now. But the reason is because the rest of the world the euro dollar is so strong that it's something called the Triffin paradox, that it's only by us having bigger debt that the rest of the countries who are passing that debt, are paying the debt or borrowing in our currencies, get increasing FX reserves and get more FX reserves, and therefore can use that to leverage up their economies. So without us growing our debt, our trade balances, I should say, because it's a twin deficit of both trade deficits and fiscal deficits. Without us growing that, we bring down the rest of the world. So the rest of the world has got to help the United States to increase, keep the currency up, keep the yields acceptable where the money keeps flowing in, to keep their economy stable. It's actually they're caught, and Charles de Gaulle said it in the 70s. They called it the exorbitant privilege, and that's what we have right now. It can therefore it can contain and can go on for a period further here.
Okay, so
I hope that made sense. I apologize, I was stumbling there with the
no. I've got to suggest I'm going to dig a little bit here. So you didn't say this, but I'm going to presume that when you said play this carefully, that there's going to be lots of opportunities for returns, very positive returns, but the risk that something could go bad at any point. That hedging would be an important part of a good investor strategy here. Is that accurate?
Yes, it is. You better learn what skews are in terms of hedging strategies to make sure that you try and neutralize as much as possible. You pretty well have to use leverage today. And I'm not recommending it unless you've got a professional, a financial advisor to really help you with it if you need to do it or whatever. But you should be hedged as much as possible, as is reasonable. It costs money to hedge. But the best way to do it is don't put money on the table that's going to put you at too big a risk right now. Because if you wait, there's going to be good money on the yields. The prices, you see them printing more money, and they will. You'll see rallies in the stock market. We may have put in a short-term high recently, or about to. We may see the markets face some pretty ugly times in the next 6-12 months, but they'll come back with printing the money, and then it'll be buy the dips, and here we go to new highs. It's not that the market's higher, which it is in nominal terms. It's actually falling in real terms, and so these littler dollars, really, it takes more of them to buy the stock, so the stock's up in price. It's Venezuela all over. It was crashing, and the stock market was going through the roof. It's always the same. So that's how you protect yourself. It's called the crack-up boom, and crack-up boom is associated with the currency falling. I'm not saying it's a crack-up boom based on that. It's a crack-up boom based on purchasing power falling, and the printing and this directing of money that's going to force up assets. Not just gold, not just silver, but commodity assets are going to be forced up, because in actual fact, they're real wealth. They're real, the hard assets.
That was my next question. So let's go here, which is, does it make sense to own the collateral? So don't worry about the claims, own real collateral like commodities, like real estate, et cetera.
Exactly. That's what you should be working on. And of course, everybody's been buying hard assets here for the last decade in quite an aggressive rate. But right now, commodities, do not go out and buy them tomorrow, okay? Because commodities we were very strong in 2020, that commodities were going to really take off, and they did. It exploded up. But we've been in a correction here for the best part of 18 months. And it's not quite finished yet. But to me, for those that understand Elliott wave, it looks like a classic 2 wave. So we put in a 1 and a 2. That leaves 3 and a 5 wave up, and the 3 is always the biggest. So I think sometime in the next 6 to 18 months, you want to have really thought through a broad-based commodity strategy, especially, Adam, when you understand what's happening with the BRICS and the Russia-China's consortium of 150 countries that are commodity exports who are moving into the Shanghai Accord, they're not going to be willing to pass off their product, which they produce, which is commodities of some sort, whether food or whatever, without and not get U.S. dollars they don't trust in return. Prices are going up.
Okay. All right. Well, look, Gordon, I have kept you way longer than I initially said I would, so I appreciate you giving us so much of your time here. I would love to just give you the open invite here to say, I mean, this really applies to anything, but to your last point there about commodities and maybe the start of the next wave 3 part of the cycle, you have an open invitation to come back on this channel anytime when you begin to feel like it's game on, right, in commodities. Please come back on and tell us about it.
Sure. Thank you very much. I apologize for doing so much talking, but
No, look, Gordon, no point necessary, really, literally, and I'm comfortable saying this on camera with everybody watching. I have yet to find the maximum upside limit in terms of content and especially data for this thoughtful money audience. People just admirably they love more data, more insight, and you've given us a great amount here to chew on.
Adam, I put out a weekly free newsletter.
That's where I'm going. Real quick, just let me ask the question and you can run in it, which is for folks that have really enjoyed this and would like to follow you in your work, what's the best way for them to do that?
Oh, just go to the MATASI.com website, sign up for the free newsletter, free charting that we send out on a weekly basis. All we ask in return is we get your feedback. We're investors. We're not selling anything. But I get tremendous feedback from our readers of our newsletters on where we're right. Typically, they tell us where we're wrong, but we learn from it, and that's what I'd ask from this session is my contribution was trying to explain this. I would ask that people give me your feedback because there's some brilliant people listening to this show that I'd love to hear what they have to say on some of these issues that we may be missing.
Well, fantastic. And I know I've said this every time you've been on, but I subscribe to your newsletter. I subscribe to a lot now, given what I do, but yours is one of the ones that I always sort of drop what I'm doing when it comes in and go through it. And just the charts alone are incredibly valuable. And then, of course, you have all of your context around that. So, Gordon, when I edit this, I will put up the URL to your website here on the screen. Again, folks, I highly encourage you to go do that. And like I said, like Gordon said, it's free. It is a phenomenal free resource out there. Very quickly, folks, if you want Gordon to come back on and next time he's seeing something material in terms of like an actionable change in what's happening on the ground here, please encourage him to do that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. As a reminder, as Gordon said, if you're inspired to take action based upon the trends that he's talked about here, most people watching here are going to benefit the most by doing that under the guidance of a good financial advisor who takes into account everything Gordon talked about here. And actually, when you put those requirements together, the professional, they're good, and they take all this stuff into account, the universe shrinks pretty dramatically. So if you've got a good one who's doing that for you, fantastic, stick with them. If not, if you'd like to talk to one of the financial advisors endorsed by Thoughtful Money, feel free to do that by filling out the short form at thoughtfulmoney.com. Only takes you a couple seconds. These consultations are totally free. There's no strings attached. There's no commitment to work with these guys. It's just a free public service they offer. Lastly, we are still offering, but not for much longer, the lowest early bird discount price to the upcoming Thoughtful Money Fall Online Conference, which is going to take place on Saturday, October 19th. So if you're interested in attending, lock in that early bird lowest price while it's still there. A reminder, if you can't watch live on October 19th, don't worry. Everybody who registers will be sent a replay of the entire event, all the presentations, all the live Q&A. And if you are a premium subscriber to our Substack, you'll receive an additional $50 off whatever the ticket price is at the time. To do that, just go to learn more, register for the conference, etc. Just go to thoughtfulmoney.com/conference. And then as we wrap it up here, Gordon, it is always such a pleasure to talk to you. Any parting last words for this audience?
No, I think we said it all, but good luck with your investing. And maybe I should say, I really applaud you, Adam, of advising that they need a professional advisor. This is not, this, you really do need somebody minimally as a sounding board on some of your thinking and their experience and people that have been doing this a long game. It's a very tricky game and you can lose a lot of money in a heartbeat. So get the best advisors you can get.
All right, great advice. And actually, hate to put you on the spot, but I know a lot of people are going to ask me if we can share the PowerPoint slides that you walk through here with them. Would you mind if I make them available for free to the folks through my Substack?
Not at all. Oh, that'd be fine. Thank you.
All right, fantastic. All right, folks. So if you don't already subscribe to the Substack, go subscribe now. Again, just to the free part. You don't have to upgrade to premium. But when this video goes out, I will, in that post, I'll have a link there to where you can download the PowerPoint slides we walked through today. Gordon, my friend, it's been fantastic. Thank you so much. Really look forward to having you back on this program as soon as possible. Everybody else, thanks so much for watching.